Let's be honest, the word investing probably conjures up images of people in expensive suits yelling on a trading floor, complex charts with green and red lines going everywhere. The entire industry seems designed to be confusing, filled with jargon like alpha, beta, quantitative easing. This complexity is intentional. It makes you feel like you need an expensive expert to manage your money, someone who will take a nice percentage of your earnings for their expertise. The reality, however, is that for the vast majority of us, successful investing is incredibly simple. It's been deliberately overcomplicated to create a barrier to entry, but that barrier is more mental than it is real. The truth is, you don't need a finance degree or a six-figure salary to begin building wealth. The biggest mistake people make is waiting for the perfect time to start. They wait until they know everything, until the market is just right, until they have a huge lump sum of cash to invest. Waiting on the sidelines is often a bigger financial mistake than investing at a less than perfect moment. The most powerful tool you have as an investor isn't some secret stock tip, it's time. The sooner your money is in the market, the more time it has to work for you through the magic of compound interest, where your earnings start generating their own earnings. Thinking you can perfectly time the market is a fool's errand. Even the most seasoned professionals get it wrong all the time. The goal isn't to be perfect. The goal is to get started. Another mental block is the fear of losing money. This is a completely valid concern. Nobody wants to see their hard-earned cash disappear. However, the perception of risk is often skewed. People see a headline about the market dropping 2% in a day and panic, imagining their entire investment vanishing. What they don't see are the decades of data showing a consistent upward trend over the long term. Investing in a single, volatile meme stock is gambling, and yes, that is extremely risky. But building a diversified portfolio of broad market index funds is a calculated, historically proven strategy for wealth creation. The risk of not investing, of letting your money get eaten away by inflation in a savings account, is far greater over the long run. Before you put a single dollar into the stock market, you need a solid foundation. Investing is for growing your wealth, not for paying next month's rent. The absolute first priority is building an emergency fund. This is non-negotiable. An emergency fund is 3 to 6 months worth of essential living expenses. Keep it in a high-yield savings account so it's safe and accessible. Why? Because life happens. Your car will break down. Your air conditioner could die in summer. You might face an unexpected job loss. Without an emergency fund, you'll be forced to sell investments at the worst possible time. That can completely derail your long-term goals. Next, obliterate high-interest debt. Credit card debt often carries interest rates of 20% or more. Meanwhile, the stock market has historically returned about 8 to 10% per year. If you're paying 25% interest, you're fighting a losing battle. No investment strategy reliably guarantees returns that offset that kind of debt. Paying off a credit card with a 25% APR is like getting a guaranteed tax-free 25% return. It's the single best financial move you can make. Prioritize it before investing. A budget is just a plan for your money. You have to know where your cash is going. Use an app, or use a spreadsheet, or a simple notebook. Track your income and every expense for a month. You'll be shocked where money disappears. That daily $7 coffee, subscription services you forgot you had. The goal isn't deprivation, it's finding waste and redirecting that money toward goals like investing. Once you know how much you can set aside each month, automate it. Finally, define your why. Your goal will dictate your strategy. Retirement in 30 years, a down payment in 5 years, building supplemental income. Long-term goals allow more risk. You have decades to ride out downturns. Okay, your emergency fund is in place, your high-interest debt is gone, and you have a budget. Now for the exciting part, opening the account where you'll buy investments. This is done through a brokerage. Think of a brokerage as a store for stocks, a store for bonds, and a store for funds. Today, this is almost always done through an app on your phone, or via a website, and it can literally take less than 10 minutes. Don't get paralyzed by choice. They're reputable. And most importantly, they offer $0 commissions on stock and ETF trades. Main choice, a standard taxable brokerage account, or a retirement account, a Roth IRA. A Roth IRA is an account with special tax superpowers. You put money in that you've already paid taxes on. Then all of your growth and future withdrawals in retirement are completely 100% tax-free. The government limits how much you can contribute each year. So it's a good idea to try and max this out if you can. Opening the account is as simple as signing up for any other online service. You'll need to provide some basic personal information, like your name, your address, date of birth, and your social security number. This is for identity verification and tax purposes. This is how you'll move money from your checking or savings into your brokerage. The whole process is guided, step by step. It's designed to be as easy as possible. Don't worry about all the options and buttons you see once your account is open. You only need to know two things. 1. Transfer money into the account. 2. Buy an investment. Ignore options trading. Ignore margin. Ignore complex charting tools. We're keeping this simple. Your mission: open the account and fund your first deposit. Even if it's just $50 or $100, the act of opening the account and moving money into it is a huge psychological victory. Your account is open and funded. You see the cash sitting there. Now, what do you actually buy? This is where 99% of people get tripped up. They think they need to find the next Amazon or Tesla. Don't do this. Trying to pick individual stocks is incredibly difficult. Trying to pick individual stocks is time-consuming, and, for most people, a losing game. You are competing against hedge funds with armies of analysts and supercomputers. Instead, we'll do something much smarter and easier. Buy the entire market. How? With a low-cost, broad market index fund or ETF. An index fund holds tiny pieces of hundreds of companies, or even thousands of companies. For example, an S&P 500 index fund holds the 500 largest US companies. By buying just one share of this fund, you are instantly diversified. If one company does poorly, it has a tiny impact because you own 499 others. It's the ultimate, don't put all your eggs in one basket strategy. Legendary investors like Warren Buffett recommend this for most people. You'll see two main types: mutual funds, ETFs, exchange-traded funds. For our purposes, they're very similar. ETFs trade like a stock throughout the day. Mutual funds are priced once at the end of the day. For a beginner, either is fine. ETFs are often slightly more flexible and can have lower minimum investment amounts. Look for funds with very low expense ratios. This is the tiny fee the fund charges you annually. You want this to be as close to zero as possible. Think 0.05% or lower. Vanguard's VOO, Fidelity's FXAIX. Making the purchase is simple. In your brokerage app, you'll use the search bar to look up the ticker symbol of the fund you want, like VOO. You'll click Trade or Buy, enter the dollar amount you want to invest, or the number of shares you want to buy, and confirm the order. And that's it. Congratulations. You are now a diversified investor and a part owner of the 500 biggest companies in the country. It's not glamorous. It's not flashy. Your first purchase shouldn't be a gamble. It should be boring, sensible, and powerful. You've made your first investment. Now comes the hardest part: doing nothing. The key to long-term success is not frantic buying and selling. Patience, consistency. The market will go up and it will go down. There will be days, weeks, or even years where your account balance is lower than what you put in. This is normal. This is the price of admission for the long-term returns the market provides. The worst thing you can do is panic sell when the market drops. By selling, you lock in your losses and miss out on the eventual recovery, which historically has always followed a downturn. The best strategy to combat fear and the urge to time the market is dollar-cost averaging. This sounds fancy, but it just means investing a fixed amount of money on a regular schedule, no matter what the market is doing. For example, you decide to invest $200 on the first of every month. When the market is high, your $200 buys fewer shares. When the market is low, your same $200 buys more shares. Over time, this strategy smooths out your purchase price and, more importantly, it automates your investing. Set up an automatic transfer and purchase in your brokerage account and let it run in the background. This removes emotion from the equation entirely. Your job is not to watch your portfolio every single day. Zoom out. Look at a chart of the S&P 500 over the last 50 years. You'll see terrifying drops, but you'll also see that the overall long-term trend is powerfully and consistently up and to the right. A good rule of thumb is to check in on your portfolio maybe once a quarter, or even just once or twice a year, primarily to make sure your automatic investments are still running. So, to summarize, you start by building a solid financial base with an emergency fund, no high-interest debt. You open a low-cost brokerage account like a Roth IRA. You make your first purchase a simple, broad-market, low-cost index fund or ETF. Then, automate your contributions through dollar-cost averaging and cultivate the patience to ignore the daily noise and let time do the heavy lifting. That's the entire strategy. It's boring, it's simple, and it works.